All right, so just about everybody that's going to attend is already here. I think Peggy's going to be joining later. Is that right?
That's right. She has a meeting across the street.
All right, so I'm gonna go ahead and call this meeting to order. And is there any other housekeeping or cleanup we need to worry about, Mike?
No.
We're good? All right, we're good. All right, the first order of business here is I'm gonna call for a motion to adopt the proposed agenda for today.
I so move.
I have a motion. Do I have a second?
Second.
I have a second and a motion, a motion and a second. Any discussion? All in favor of adopting the proposed agenda today, please say aye.
Aye. Aye.
Aye.
Opposed likewise? The ayes have it. We have an agenda. All right. All right. Welcome. Next up is the approval of the February 13th, 2025 minutes. I hope you all had a chance to read and review those. And if so, I'll call for a motion to accept those as presented.
So moved.
I have a motion to accept those as presented. May I have a second?
Second.
I have a motion and a second. Any discussion? Hearing none. All in favor of approving the minutes as presented from the February 13th, 2025 meeting, please say aye.
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 Opposed likewise? The ayes have it. We have an approved set of minutes. Mr. CEO, Mike, I'm going to turn it over to you to introduce our guest this morning.
Thank you, Mr. Chairman. Next up on the agenda, we're going to have an educational presentation on commercial real estate from Kathleen McCarthy from Blackstone. She's the co-head of real estate at Blackstone. As I think the commission is aware, we're an investor with Blackstone, and Blackstone is the largest owner of commercial real estate globally, and also an industry leader in opportunistic core plus and debt investing across North America, Europe, and Asia. Ms. McCarthy focuses on driving performance growth for Blackstone's real estate business. She previously served as a global chief operating officer of Blackstone Real Estate. Before joining Blackstone in 2010, she worked at Goldman Sachs, where she focused on real estate investments. And she had received a BA, a Bachelor of Arts degree from Yale University, and very distinguished. And we're fortunate to have her with us today and to talk to us about commercial real estate. So, Kathleen, I will hand it over to you.
Thank you so much. It's a treat to be with you all. And I think I probably made the technology a little more complicated because I asked that you get to see me in the flesh, not just in that beautiful photo, which isn't kind of real life, before I get going. And I'll just start by expressing my gratitude, Blackstone's gratitude for the partnership we have with South Carolina across the firm, but particularly here in real estate, which is what we'll focus on today. And I don't take lightly the opportunity to be with you all and to share our perspective on the market, which hopefully is really additive to your decision making. And I know the team, the investment staff, is going to have more of a dive on real estate later today, and hopefully this will be helpful to that as well. So I think Robert might be driving the slides, and if you could pull up the first one, I can't see it, but you could just let me know if it's up. Excellent, thank you.
There we go.
So, and I'll just say, style-wise here, I'm going to move through a bunch of slides, first about the general market overall, and then we'll talk about specific sectors reasonably quickly so that we can get to a Q&A, because I want to make sure I address all of your questions and concerns. So just quickly a snapshot of the Blackstone and South Carolina Retirement System partnership. We've been investing together for 13 years. It spans about $850 million of investment across two primary strategies. BREP, which is our opportunistic real estate funds. Those are funds that are seeking higher returns and therefore for investments in high quality real estate that have opportunities for us to lease up space, drive operational improvements, grow cash flows over a shorter duration hold period. In our BPP funds, these are called Core Plus funds, that's on the right side of the page. These funds buy more stable cash flowing real estate with a goal to grow value over time through growth in cash flows. Across all of it, again, we emphasize high quality real estate. And in a second, we'll talk about how we invest consistently thematically across both of these. Next slide, please. Thank you. So Blackstone is the world's largest owner of commercial real estate. And we think for your investments, that gives us certain tremendous advantages, particularly around the types of transactions that we can source and invest in, things that are large and complicated, and where setting up new investments may allow us to establish lower going in values because of less competition at the scale we invest at. I think one of the most powerful things we have, though, is really the information advantage. We have 62 portfolio companies that we have either bought and enhanced or created ourselves. You can see some of the brand names across the spectrum of different sectors on the bottom half of this page. These are companies that we own and control through your funds. There's 12,000 underlying assets that these companies operate, and we get the benefit of real-time information. So when we're trying to figure out what to do next, whether that's what we're buying, what we're selling, how we're financing something, how we're driving those value creation strategies, we think that gives us a real advantage. And we have a heritage of using it. I think a lot of folks talk about using lots of data and data science, but even before those vocabulary words maybe existed, we were really harvesting information to really make great decisions for our investors. And all of this information, all of our decisions, we funnel through one global investment committee process, the same way we have been doing for the last 33 years in our business. And that's a time-tested process. And I will just tell you that I think these advantages of the scale and the information ecosystem and the time-tested process, they serve us well in any environment, but I'd say particularly in one like the one we're in today, where there's a lot of uncertainty, a lot of volatility, and we have the ability to stay calm, lean on our process, and lean on our information advantages, and then deploy with the substantial capital that investors like you entrust us with. Next page, please. This is just a snapshot of the Blackstone real estate portfolio overall. I think the main takeaway for this slide is just how concentrated we are in the sectors that have been outperforming, and we expect to continue to benefit from long-term secular tailwinds. So 75% invested in logistics, residential assets, and data centers. Warehouses are benefiting from e-commerce growth and onshoring of manufacturing. Residential assets have had very attractive supply demand fundamentals, and we think will continue to do so because of relative lack of supply compared to the demand for it. And then data centers. This is really the digital infrastructure that is supporting the digitization of absolutely everything happening in our lives. And this has been a growing area of our portfolio, really, as we seek to, again, use the strengths we have to try to focus on driving outperformance for you. Next slide, please. So this is where I start to take a step back, and we'll talk about what's happening in the real estate market. But the first thing I inserted into this presentation in light of the events of the last week is just a page to try to provide you some reassurance maybe about private real estate and the role it can play in South Carolina Retirement System's portfolio, particularly if we're facing down markets. This is just trying to provide a graphical way to see how real estate has performed in tougher market environments. And what you see is that in 7 out of 8 years where the S&P had a downturn, private real estate actually delivered positive returns. And I think we know, and I'm sure you'll talk or you have talked to various consultants and folks who know a lot more about portfolio strategy and construction than me. Real estate is uncorrelated to the public markets. It drives inflation protection, it provides inflation protection, it provides income growth. But I think this also in particular snapshots how real estate can provide real ballast to your portfolio and potentially stronger performance in a tougher environment. So speaking of the real estate environment, we'll flip to the next slide. I probably don't have to tell all of you that it's been a tougher couple of years for real estate. I want to assure you, though, it feels that we are turning a corner. And I'm going to take 2 slides on why we think that. The first is that the cost of capital is coming down. And here, this gives you a little picture of across the world what's happening with base rates. Obviously, they are down from their recent peaks and they're projected to go lower. This is not something we can control, of course, but we do think kind of this is heading in a more positive direction. On the next slide, you can see how actually debt is returning to our sector with more capital coming back, and that is helping to drive all-in borrowing costs lower. So on the left-hand side of the page, you see what happened last year as the CMBS markets reopened. We saw a 3 times increase in debt issuance compared to the prior year. And what's good, the good news has, I'd say, continued in this space as banks have come back in lending to customers like us on high quality assets. That is supporting lower borrowing costs, as you can see on the left-hand side of the page, which isn't just about government bond rates and base rates. It also has a lot to do, as you can see, with the spread to those base rates, which have come down sharply and are bringing in the cost of borrowing materially. The other, next slide, please. The other tailwind really supporting the recovery in real estate values is sharply lower new construction. So what has happened is that higher input costs and higher labor costs have driven construction costs higher, replacement costs, if you will. And you layer on top of that higher interest rates. And the reaction function in the real estate market is that new supply has come down sharply. You see here just multifamily and logistics down nearly 2/3 from recent peaks. And this is so important because it sets the stage for strong operating performance and cash flow growth going forward. Next page. I mentioned cash flow growth. I think the good news that maybe has been lost in some of the negativity about real estate is that actually, particularly in the sectors where we focus, logistics and rental housing, you've seen cash flow growth not only resilient, but you're positive in the mid-single digits. This is just a 2024 snapshot, both of the really of the U.S. REITs on the left-hand side of the page, and then our portfolio in particular on the right. But this is a key component of our optimism in terms of the resilience of cash flow in a tough environment and the way we can propel that going forward, particularly given what I had just said on the prior page about new supply being down sharply. Ultimately, what this next page. When you think about capital coming back, cost of capital coming down, new supply down sharply, this signals to us that real estate values are going to be higher at the end of next year, at the end of the following year than they are today, certainly where they were last year. And so what we've really tried to do with your capital, and in particular, the commitment you made in our most recent opportunistic fund, Rev 10, is we wanted to really lean in and capture the value. We've had a highly dislocated market, as you know, and we have these advantages of scale capital at our disposal, conviction themes that we had established long before this moment of disruption. And so we focus really on large, complicated transactions that not everyone could get done, but really allow us to establish ourselves and your investments in high quality business and assets. So if you kind of take a little tour around this page, you'll see in the top left a data center business that's the largest in Asia Pacific, really highest quality data center company in that region, which is highly underserved today relative to the population for data center infrastructure from our perspective. You see public companies as far as take privates in the housing space, in retail as well. And then across the world, us expressing this view as well in markets like Japan and Europe too. I will flip now to a speed round through the sector. Again, hoping to provide a little illuminating material for your conversations later in the Q&A. But if we flip, maybe it's 2 slides ahead, past the sector overview page, there we go. So first page, just touching on logistics. As I said at the beginning, logistics represents nearly 40% of our real estate portfolio. I think one of the more remarkable things that has happened over the course of my career in real estate is that the world shifted from everyone only wanting office buildings and retail shopping malls to really wanting these kinds of assets that we have put into our portfolios for over a decade now, this one in particular. And it's because this sector, which in history really only tracked GDP growth, has faced surges in demand from just the way the world is changing, right? E-commerce growth continues to expand. You've seen 3 times e-commerce sales growth versus as a percentage of total retail sales since 2019. We are seeing the benefit of manufacturing onshoring. And I will note that this predates any announcements of the past week. You can see here the statistics are since 2021. As my colleague who runs our asset management business says, when Intel opens a plant, we may not be invested in that plant, but that basically spurs a ton of demand for logistics space in and around that area. And then finally, today in this environment, we're seeing a sharp decline in new starts because of the cost to develop and the cost to borrow. And we think that sets the stage to continue to benefit from this trend in a way that may pull through in cash flow and valuation increases. Next page, U.S. multifamily. So U.S. multifamily nationwide has experienced elevated supply in the last couple of years. You can see that on the right-hand side of the chart, Q4 22 through Q4 24. We are now moving past the peak of that, but that was really a result of some of the things you saw unfold during COVID, where there were significant population moving to the south of our country in particular, including South Carolina, low cost of capital that put a lot of assets into production. But that has come off sharply, and that's what you see on the right-hand side of that graph on the right. And what I would say, one thing that is quite encouraging and telling about the residential housing market in the U.S. is that actually through all of those deliveries, apartment demand and rent growth has been quite resilient. And that is simply because there is a backdrop in our country of insufficient supply of all forms of housing. And that has led rents to be pressured from the new supply, but essentially kind of flat year over year if you look at the Sunbelt markets overall. And if you look at the coastal markets where there's even less supply, slightly more positive than that. So we have had high conviction in rental housing, again, because of all of this, and we continue to have that going forward. The next page just gives you 2 examples. I promise I won't do examples on every sector, but just a couple of examples of apartment investments you have through your BREP and BPP investments. On the left-hand side of the page, Apartment Income REIT. This is a company that we took private last year in a $10 billion transaction. This is high-quality assets concentrated in coastal markets, benefiting from that stronger rent growth I mentioned in those more supply-constrained cities. And then on the right-hand side of the page, there's a community in New York where I live. I'm not there today, but it's called Stuytown. It has 11,000 units of middle-class housing that were built after World War II. When we made this investment, we committed to voluntarily preserving roughly half of them as affordable and really enhancing the community experience. And so this is kind of a one-of-a-kind type real estate and really fits with that strategy I mentioned to you at the beginning, very stable and long-term performance driver of your portfolio. Next slide, I'll just, anytime we talk about housing, we do want to provide our investors reassurance that we are highly focused on the fact that we are entrusted with managing people's homes, and we bring a resident-centric approach to everything we do. And that includes treating everyone with respect, with great transparency, striving every day to improve the quality of their experience in the communities that we own and operate. And we're really proud that that does pull through in resident satisfaction scores, as you can see on the top of the page, where when we buy a community, we come in and manage it, we see a 20% improvement in resident satisfaction. And I think that, in combination with the fact that our properties are highly occupied and wonderful places to live and build your life and your family, is something we're really focused on, and we strive to deliver in every case. All right, next topic, data centers. So, again, I suspect in the Q&A there'll be a lot of curiosity about this sector. Certainly, it's in the press a lot. This, as I said earlier, is our newest theme. Really propelled by the underlying trend of the digitization of absolutely everything in our lives. So whether that's the content, frankly, calls like these, payments, and then of course businesses and other operating systems moving to a cloud, and now the wave of AI implementations that are coming on. All of these really make us believe that we are just at the beginning of demand for data centers, really the infrastructure that allows all of this computational power to happen. One of the great things about being a real estate investor in this tech space is that you're not picking which company is going to be a winner, which type of technology is precisely going to be the one that survives for 30 years. You're providing the foundation upon which all of these businesses and these implementations are happening. And it's a space where there's really natural supply constraints to oversupply natural constraints to oversupply because of the cost and complexity to build these, and then additionally the power requirements that are really how they are leased and utilized. And so this is a sector where we really focus. If you go to the next slide, we were really, I think, early as it relates to the real estate kind of investments community, thinking about the future of real estate and how that would drive performance for data centers. In 2021 in BPP US, your fund, we took private a company called QTS. It was the 5th largest data center business at the time. It's become the fastest growing in the world today. We followed that up, as I mentioned earlier, last year, buying another great company in Asia, AirTrunk. And really, in every one of these situations, we're trying to capture the outperformance that the tailwinds from technology are providing, but also really protect your investment by making sure that every project we pursue is 100% pre-leased to investment-grade tenants on long-term leases with very flexible formats, so that now and in the future, different technological uses can be installed in these data centers. Are not purpose-built for one tenant or one use. Next slide, hospitality. So this I'll just touch on today. This is a smaller portion of our pie, but no less interesting to us. This is probably our longest term high conviction theme, and where Blackstone has more experience than anyone. It's not on this page, but if you look at just about any demand trend in the hospitality space, it'll show that for over 30 years, there's been kind of up into the right movement for flights and hotels and conferences and things that bring people together and provide experiences in places away from home. And this is really the theme we've been investing behind. And again, the combination of performance that varies by region, but continues to be positive in the hospitality space with new supply down has made this, again, a very interesting place for us to continue to source new investments for your capital. If you flip to the next page, office, I will say there is kind of new news for us here. We are finding opportunities selectively to invest your capital after probably over a decade of being very cautious on the sector. And while there continue to be headwinds for lower quality assets, and you kind of see that reflected in the left-hand side of the page, where the US market overall remains 25% vacant, this is a place, maybe like real estate overall, where you really can't paint the sector with a broad brush. Because if you look at places like Midtown Manhattan in New York, and if you go, you can see the same phenomenon happening in Paris, over in France. What's happening is, as people are back in the offices, but businesses are seeking really the highest quality spaces in the best locations, you're getting the most, what we call compression, most demand, and now movement in rental rates and lease terms in particular pockets, in particular assets. And we really want to focus on those. An example recently in Midtown Manhattan is 1345 Avenue of the Americas, which your BREP 10 fund is investing in, where we're buying essentially a half interest in a high quality, recently renovated, highly leased building at a very favorable basis that we think only really available to us because of the continued challenges in the broader office market and the sentiment around the space. Next, and kind of final sector to just touch on is retail. This is another place where we have been cautious for over a decade. all of that conviction about what was going to happen to warehouse demand because of e-commerce made us more concerned about demand for retail space. And certainly there has been, huge changes in the way people are consuming and buying goods. But one thing that has been really resilient and proven itself to be so is grocery anchored shopping centers, community shopping centers, the places you or I go to buy our groceries, grab a coffee, go to the gym, I get my nails done. And what has happened because of the huge challenges to the retail space overall over a decade is that people haven't been building more of those spaces. And highly dense population centers may not even really have a lot of places to put those. And so what we have really been focused on is accessing community-based grocery anchored shopping centers. And kind of in true Blackstone style, if you go to page 20, last year, towards the end of the year, we announced the acquisition of a publicly traded grocery anchored shopping center REIT. This is on page 20, if you wouldn't mind forwarding. A company called ROIC. So again, this is a great company that you now own. It was a $4 billion transaction. An example of how if we like something, we don't just want to do lots of, try to do little transactions, but really kind of in a big way, give you access to high quality real estate to a high quality company, but really specifically focused on this grocery anchored space. And in this case, these properties are highly concentrated, particularly on the West Coast, in dense communities. Therefore, we've been providing long-term demand for these spaces. All right, well, I will pause there. And it's up to you, but we could bring down the slides if that's easier. And again, I just wanted, before we start the Q&A, reiterate my thanks for the opportunity to be here today, and of course, to be a steward of your capital.
Question?
Kathleen, this is Jeff Berg. Thank you so much for joining us this morning. Can you talk a little bit about, the topic of the moment, how policy can, or maybe can affect real estate, and what parts of real estate do you think really are less susceptible to positive or negative impacts from federal policy?
Yeah. Well, I'll say, of course, thank you for the question. It's certainly the right question. I think, first, I'll just say, of course, the situation is fluid, and nothing I say today I can say with 100% certainty. But like I highlighted at the beginning, I'd like to believe we have a real advantage on picking up the signals of what all of this may mean, whether it's long-term impact or kind of short-term, how some of the policy announcements might impact decision-making for tenants across the real estate spectrum. I think the first thing, the first place our minds go to in this is back to that new supply or construction picture. The policies announced would increase construction cost, and again, I think that puts more pressure on the economics of new projects. And so, if implemented as described, our expectation would be that construction projects continue to not only cost a lot, but cost even more to build. And that would mean less new supply for potentially a more elongated duration. And that's actually a positive overall for real estate. So I think that's what one silver lining potentially of the policies. I think in the uncertainty of the moment, one of the things we're watching for is just do corporate decisions slow down as people evaluate the needs of their businesses, the impact of their businesses. We haven't seen that yet. In fact, particularly in logistics, which you might think might be the first place impacted, actually we've continued to see strong demand for leasing. But that's something we're really watching for intensely. And the final thing I'll just highlight, particularly because the funds you're in have high concentrations in multifamily housing, is that is a theme, and I think an investment strategy that survives tons of change in technological change in our world, certainly because people don't live in their phones. Maybe sometimes people think their teenagers are living in their phones, but they're not actually living in their phones. And then I'd say additionally, and to some degree, unfortunately for the country, higher construction costs will likely mean less supply, and that will be supportive for cash flow growth in the existing real estate which you own.
Continuation on that, can you kind of zero in a little bit on industrial? Because we've had this sort of rethinking of supply chains, which certainly has implications for industrial, and it is obviously early going to try to guess where policy winds up, but maybe if we go to a high tariff world versus a more modest tariff world, what are the relative implications for industrial?
Yeah, I think I'll start with the places like most vulnerable. I think port markets, right? So that's the place where we feel like there'd probably be the most potentially most immediate and intense impact from significant tariffs or lots of negotiation over higher tariffs. And that's a market that's probably more vulnerable just because it does depend so much on volumes coming through ports. I think I personally believe that it will take time to really enhance the onshoring of manufacturing. But as I mentioned, since 2021, we've really already seen the benefit of more onshoring of manufacturing driving demand up for logistics spaces around the country. And it really all is kind of depends on where the nodes of that manufacturing activity is. It's not, you basically follow the markets similar to how we do it generally in real estate, follow the jobs, follow the market, follow the heads. And that's the kind of real estate we want to invest in. And so that could be supportive for in particular, domestic logistics. I think the only other thing would be certainly the combination of uncertainty or any chilling effect that tariffs might have on growth. Would be something we have to be considering in terms of our sort of projections of leasing activity and then also rent growth in portfolios. Does that answer your question?
Yes, thank you.
Kathleen, this is Bill Condon. Thanks for being here with us. And I appreciate your comment about the risk to the ports. I mean, South Carolina is very dependent, a small state, but very dependent on its port, which of course leads to BMW and other businesses being here. But my first question is how do you see that immigration enforcement and deportations affecting demand in residential housing?
Well, I'll start by saying, in our whether it's folks we employ or folks we house, we're always focused on proper documentation for all of the humans that are passing through our real estate. I'd say we have not seen an impact from the more focused sort of focus on undocumented or other immigrants to this country. We've not seen that pull through in our residential housing. It's again possible because we had insulated ourselves from that again by our own policies and procedures, and also by the nature of the communities we own. We are not major developers, but I have heard from folks who really do focus on new construction in their businesses that they are seeing some impact on their construction sites where they might have subs who have folks who potentially themselves are properly documented, but may have family members who are not, and that causes some disruption, I think, to work on the project. But that's not something we have seen directly in our portfolio.
Thank you. And the second question is, you mentioned that a lot of new commercial, again, I don't know if you were talking specifically about data centers or distribution centers or whatever, but that they foster a lot of other development of companies that serve that business. Is that true with data centers as well? You know, I hear data centers, they're all equipment based. They're not very few employees, but what kind of businesses grow up around these data centers?
Yeah. Well, it's a great question. I think one is, the construction sites themselves, these are massive multi-year construction projects. There are significant jobs and really high quality, sophisticated engineering and construction jobs associated with building those projects. And these projects also tend to be in places where there is access to power. And as a result, you're unlikely to see just one data center. You'll see basically an ecosystem built and a technology ecosystem built around it. As an aside, I'll say, in the conversations about how will we power our own demand for all of this computation, because again, it's all of us in our personal lives and our businesses, wanting to access these technologies. So it's really, we, I think as humans, as businesses, really driving the demand for this. How do we access that power? Because of some of the challenges in the grid in the US, it's been more practical to build the data centers where the power is, particularly in places in the center of the country, for example, that may have high access to power and even renewable power, but may not today have that technology ecosystem. So I'd say that's what we have seen in markets like in Atlanta, where QTS has expanded significantly since we acquired the company, is that it's not just the data center system itself, but it's also, again, I'd say the whole tech attached ecosystem that builds around those businesses, because the ultimate tenants are the biggest technology companies in the world. And that, I think really enhances the diversity of the employment picture overall for the long term in those communities. The other thing I would say is on the power point, we have seen how really technology companies and data center developers are leading the way in the energy transition. So as our country, is trying to find more and differentiated ways to produce power, a new data center and the tenant that occupies it acts as almost I describe it as an anchor tenant to new power generation projects. So a power generation project that might not have made sense or might have been considered highly risky if you didn't know who would take the power if produced. The technology companies and the data center businesses who provide that certainty and therefore enable the creation of that power.
Thank you.
Kathleen, one more from me. This is Jeff again. What sort of niche area in real estate do you think is the most profoundly beaten up right now, relative to where you think it should be? Not saying there's a turnaround imminent, but what's really had a tough go of late?
Well, I would highlight office, and on some level, deservedly so, because there is a lot of office in America and around the world that is, I'd call, functionally obsolescent for the way companies and people want to work today. And those are the kinds of assets where we're all thinking about kind of alternate use or redevelopment, because it's the path to leasing those assets, making them economically viable as is quite uncertain. But I think when I think about, for example, I mentioned this transaction 1345 Avenue of the Americas that we're acquiring. We're really on your behalf. We're buying it at a huge discount to what we think of as the cost to replace it, and a meaningful discount to where the seller bought it, invested in it over a decade ago. Even though the asset is high quality, 92% leased, strong path to being fully leased. And we see these kinds of opportunities percolating around the country, particularly in office markets that are not yet showing some of the strength that Manhattan is. New York has the benefit of having a broad and diverse financial services-based economy. And those are the businesses and the companies that have been most forceful, I guess you could say, in getting everyone back to work. And so you're seeing the benefits pull through into the office market the fastest. That hasn't happened quite yet, but we feel is coming in, for example, the more technology company dependent markets. But that's starting to change. And yet the office sector remains quite beat up and presents some very interesting opportunities.
Thank you.
Any other questions? Any more questions for Ms. McCarthy?
Kathleen, thank you so much for taking the time to be with us today. It's been a very enlightening presentation and obviously very relevant for us. And we appreciate, as we've said previously, we certainly appreciate the partnership with Blackstone. Thank you so much for being with us.
Thank you. Appreciated all the questions. It's the most fun part of the presentation. So if there's anything ever that we can help with, questions we can address, certainly the world is always a changing place, and we're happy to provide any illumination we can. So thank you.
Thank you.
Thank you so much.
Bye. All right. So next up on our agenda this morning is we've got a line item to go into executive session. Mike, would you read the motion, please?
Yes, sir, Mr. Chairman. Motion to proceed into executive session to discuss investment matters, including comprehensive reviews of the bonds, Port Ralph and real estate portfolio performance, and a discussion of various underlying holdings and certain portions of the consolidated annual investment plan and statement of investment objectives and policies pursuant to SC Code Sections 9-16-80 and 9-16-320. Also to discuss personnel matters and to receive advice from legal counsel pursuant to SC Code Annotated Section 30-4-70A 1 through 2.
May I have a motion, please?
Who moved?
A second?
Second.
A motion and a second. Any discussion about the motion on the table? Hearing none. All in favor to recede into executive session, please say aye.
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 Any opposed likewise? The ayes have it. We are in executive session. I'd ask the staff to
Of the policies, the document, both a clean and a black line version of the document were posted for the commission. The document is substantially similar to the document that you saw that was presented at the February meeting. There were a few technical and conforming changes, but nothing of a substantive. Sorry, something I said. As described previously in the previous meeting, the primary purpose of the updates to the AIP, SIP were to incorporate the commission's, the results of the commission's 5-year asset allocation exercise that we have completed. So most of the changes are related in the document are related to that. But pending any questions, we have a motion for the commission to approve.
All right, so we all had a chance to go through both the eye-crossing red line version and I'm being serious, and the final clean version. Is there any questions or discussion on this before I call motion to adopt this? Everybody good?
Cover me.
All right, Mike, would you read the motion for us, please?
Just one caveat, as become our practice, as part of this motion, we will certify compliance with the Sudan divestment policy. If you'll recall from previous years, the Sudan divestment policy requires us to divest from companies that are involved in the Darfur regional conflict. But there's an exception if you're indexed, your public equities are indexed, and because our public equities are indexed, it really doesn't, the policy nor the statute applies to us. So we're certifying compliance by saying basically that we index our public equity portfolio. So you'll hear language to that effect in the motion, but I just want to make sure that we were, just to remind you of that. So the motion is the commission adopts the recommendation of the CEO and CIO to approve the proposed revisions to the consolidated annual investment plan and statement of investment objectives for the fiscal year 25-26 as set forth in the red number document, pages 110 to 165, with an effective date of July 1st, 2025. Certifies that RSIC is in compliance with the Sudan divestment policy without taking additional action due to the method of implementation utilized in the portfolio. And 3, authorizes staff to finalize the AIP SIOP by making any technical revisions or formatting edits consistent with the action taken by the Commission.
May I have a motion? I have a motion. May I have a second?
A second.
I have a motion and a second. Any discussion on this before I call for a vote to adopt? No discussion. All in favor of adoption, please say aye.
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 Any opposed? The ayes have it, and we have approved the, yes. Mike, anything else before we move on?
No, sir. Just moving on to the quarterly investment performance update would be next.
Recognize Mr. Berg.
All right. I am going to recognize Mr. Moore, who is now our performance czar.
And you are duly recognized.
Thank you.
We won't hold the staleness of.
This is very stale, so what I was going to say is
Okay.
I'm going to keep the presentation relatively brief
Brevity
and
in this,
hit the highlights if you're okay with that.
You have the floor, sir.
All right. Well, key takeaways starting off was we ended the year with a plan near an all-time high of $47 billion. $2.5 billion of that represents value that our team has added to the portfolio through our implementation over the past 3 years. And then, as I noted in my last update, we've reduced our off-benchmark risk at higher risk exposures while positioning ourselves for this market volatility, and also our SAA changes that were just approved. So we're going to get ready for hopefully take advantage of some of the volatility that we're going to see now. So as we hit into performance, I do want to call our attention to the 5 and the 10-year performances. Red line here represents the 7% assumed rate of return. To note here, our policy benchmark did not meet that hurdle, but our implementation over those 5 and the 10-year periods have allowed us to meet that hurdle. So in the words of Mike, and he emphasizes this a lot, our mission is to make the plan work, and through our team's contributions, this has been one of those ways that we've been able to achieve that goal. So hats off to the team as we've navigated a pretty challenging period of time, which included COVID and other volatile periods of time as we're experiencing today. This is very outdated at this point, but we had started to see at the end of the year some volatility around the markets trying to price in new policies that were being introduced. So we've seen that play out quite a bit over the past week or so. But what I want to call out here, this is our performance framework. 2 areas I want to call out, so I highlighted them by boxes. The first one being the value from diversification. So this is how we look relative to how our 5-asset policy portfolio looks relative to the reference portfolio, the 70-30. Negative, not something we want to see all the time, but what I will note is these numbers have meaningfully improved over the past quarter performance, and I would expect those to also continue to move closer and closer back to the positive as we believe diversification will benefit our portfolio in the long run. The other area that I want to call out here is our actual versus policy, and really the fiscal year to date number is the most interesting one to call out here. This is really a reflection of us trying to be as closely aligned to the benchmark as possible as we go through some meaningful changes within our portfolio. So this is performing exactly how we would want it to, as we kind of say sometimes it's okay to tread water, waiting for the right opportunities. That's what we're seeing today. Very stale, so I'm going to just quickly kind of run through these slides on the fiscal year to date performances, so only picking up the first 6 months of the year. But again, the big thing I'll call out on this fiscal year to date slide is this allocation sleeve measures how different we look relative to our policy. So you can see that's quite de minimis, and that's something that we continue to strive towards. All right, getting into things that are a little bit more time or longer term in nature, the 3-year for us, zooming this out, this is really a reflection of our ability to navigate difficult and challenging and ever-changing market environments, really with a focus on executing baselines. And what I can take a lot of comfort in from this slide, as should you, is over the past 3 years, every asset class has added value to our portfolio above their policy benchmark. So this is very meaningful. This is telling us that our baselines are very, very well constructed in the sense that we're thinking through not only the top-down portfolio construction, but also how do we implement these asset classes, and this is really a reflection of that. And then this is very much a reflection of past investment standard deviation risk. We'll have a more real-time assessment next time we meet, as these numbers are quite meaningfully changing. But in closing, I just wanted to cover that I'm very pleased with our fiscal year-to-date performance through the end of the calendar year, and we will continue to execute on what we've created here in terms of building out our ability to counterattack in environments like today, and also to be able to really weather it for the long-term value of the plan. So happy to take any questions, but hope to have a more real-time discussion whenever we meet again in next meeting.
Thank you, Brian. Any questions for Mr. Moore?
I've got one. Can you go back to the chart of the not of the returns, but the comparison of policy and actual and all that stuff?
Oh, this one?
Yeah. So the bottom right box, I probably heard you wrong, but it sounded like, and of course, we're green, all greater than the policy, but I thought I heard something like, you know, we want to be close to the policy.
Yeah. Absolutely. We absolutely want to see that number as high as possible. And that's really what's played out over prior periods. So the 3 and the 5 year, we've added a tremendous amount of value by looking, through manager selection, by constructing the portfolios that we've constructed, or what we talked about, leaning into credit when it pays to lean in when spreads are wide versus not holding any credit when spreads are low. This is really a reflection today of we don't necessarily feel like there was a tremendous number of opportunities to look different than the policy. So in absence of having conviction, we really were trying to reduce tracking error as much as possible.
Okay.
So that was really the driving force. But we do still have things like portable alpha that you should expect to outperform over time. And
Can you go forward to that slide that has that? No, not that one. The one that has the near zeros on allocation. That one. So, Bill, all of this, we want you to be able to find the question to ask. If you see big numbers in the leftmost column, that means we look different. So, we're trying to, make it easy for you guys to figure out where the questions would be. And hopefully we go there regardless. But so this is, to Brian's point, we don't believe that there's anything that really stands out as a
Okay.
The only place, it's actually a great question, and actually glad we actually got back to this was one of the ways we do look different though is we don't hold as much credit in our portfolio, and we actually were holding more cash and treasuries. So that's where we're losing on being, at least for the first half of the year, we were losing on being defensive in bonds. That wasn't a great call because credit had continued to tighten and we weren't earning that incremental spread. But now, so we talked about portable alpha. Portable alpha is adding a meaningful amount of value, but it's really offset by our defensiveness in bonds. So that will hopefully self-correct itself in this current period of time where the bonds portfolio should hopefully be a better ballast to the rest of the portfolio.
Yeah.
That being said, yields are rising, so the characteristics may or may not be there this time around.
Right.
But it's a great question because you have to look under the hood to really understand kind of some of the nuances to this. But it's something that each one of these has a different meaning. I think each one of them is just as important, but at the end of the day, that's the package that kind of gets us to we feel really comfortable with where we are, and we're actually excited about the opportunity if we do see some additional sell-off in the market.
Great. I don't walk away with a question in my mind.
That's 38. Should that be 39?
Or,
Is that right or wrong?
There's rounding.
There's rounding. This is not an exact science at all. This is very much, anytime you're applying, this is including 2 quarterly attributions. So King is in here if we have questions on that, but it's very much driven by, these aren't necessarily great to be linked together. So as you get further and further out, it becomes less easily to kind of piece this together. So there's some rounding effect in this.
All right.
Thank you.
Oh, we have Mr. Chairman.
Mr. Berg, Delegated Investment
sorry.
Report.
John, will sound like a broken record. This is we closed one investment.
Been busy.
Since,
Wait till next meeting.
well under the 5% threshold. So, there you go.
Thank you, Mr. Chairman. You're correct.
They liked where they were.
Well, we're in private equity, so we're on that hamster wheel. We got to keep committing capital, but just so happens we have not closed anything. Okay.
HG Saturn, that name is new to me. Give us, since we only have this one, give us.
Yeah, so HG is their European software private equity firm. We actually invest in 2 other vehicles that they have, so hopefully I don't butcher them. We have HG Saturn, there's HG Mercury, and HG.
The other one's the one that I know.
Yeah, it's not a planet.
Yeah. No, is it?
Yeah.
Genesis? Okay.
Genesis,
All right.
HG Genesis. So HG Saturn represents their large cap vehicle. So it's a very successful platform. They've been, they're executing a kind of buy and build software approach in Europe, and they are targeting all the different types of services. And HG Saturn is actually one of the funds where we see quite a bit of additional co-investment flow that comes through. So we co-invest alongside, I don't have the exact number in front of me, but we'll follow up with that. But
They've been great partners.
we have quite a number of co-investments with them, and it's been so we've been with one fund series with them. We were in HG Saturn 3 as well as the other vehicles, and so this is a high conviction name for us. We think they're doing a lot of interesting things. And Europe is one of those places where there's less competition for deals, and there's more regulation and rules around different pieces of it. So labor and everything.
Certainly is more regulation.
So this is one where we feel like we're able to, we feel like we're going to be able to add quite a bit of value.
Okay. Is there anything else, folks? Having nothing else on the agenda and no one bringing any other items to the floor, I'll call for a motion to adjourn.
So moved.
A motion and a second. Any discussion? All in favor of adjournment, please say aye.
Aye.
All right. Safe travels, everybody.
Yep.